All right, before you go and pay for a financial advisor, we just want you guys to hear us out real quick because they're very expensive and we don't want to discredit financial advisors, but there's just information that if people knew this more, they might not go and rush to a financial advisor because investing is really not that hard. So, Newski, let's really just kind of break some things down for them, bro.
Yeah, and we're about to share a bunch of links with you guys, so make sure you follow along and watch the entire video and hit that subscribe button right now and like this video because it does help out the channel a lot for us, right? So let's just get started. Right now, if you're looking to book a financial advisor and sign up, it's probably because you need help managing your money. You think you don't know what to do with your money. You don't know how to invest, right? Let's just break this down. Rel, what if people came to you right now, right? And your financial advisor is there, you're talking to this person and you're like, yo, I'm paying you a fee, okay? You're managing my money. Here's a stock that I'm about to tell you to invest in. Apple. How would that make you think, bro? What would you feel?
I feel like, bro, that's the best you can come up with. Like, you're supposed to be a professional. Like, give me that stock nobody's heard about that's about to go 500%. You talking about Apple?
Exactly, right? It would confuse you. And the next stock I got for you, ready? Watch this, bro. Microsoft. Right?
Oh my gosh, brain blast.
Exactly. You will be confused. And that's exactly what most people right now, guys, are investing in. And we're about to prove this to you guys right now. So this on the screen that you see is called VOO, which is the Vanguard S&P 500 ETF, which is essentially investing in the top 500 companies in the country. So let's just think about it, right? Well, obviously you believe in the country, you believe in the way it's going, and you know that it produces good results, right?
Definitely.
So if I look at the top holdings of this fund, remember 500 companies are in this fund. Let's just go down and scroll to find out the top holdings. You got Apple at 7.1%. You got Microsoft at 6.2%. What does that make you think when the rest of this is like, what, 2%, 1%? What does that make you think, bro?
I mean, it just shows you how much they pretty much value these companies. Like, it's just a known thing that Apple and Microsoft are the head of the stock market. As you see, they make up about 13%. Because in case you guys don't know, these companies are weighted different. Like, yes, there's 500 companies in there, but they don't all value the same amount. You know, that's a difference. So they actually put more emphasis on Apple and Microsoft. They really drive the fund for real.
Exactly. And let's think about it. So when you look at it and say, yo, how has this fund performed since it started? Okay, it's been producing 13% for you, 13.76%. It's giving you that on average every single year. So now what I want you guys to think about is what this FA is telling you differently, right? The job of a financial advisor is to help manage your money, is to help protect your money, and obviously build your financial growth over time, right? Like, build it up for you. So at the end of the day, you're paying them a fee. But if you can invest in something as simple as this, which is VOO, and get back 13% without paying anyone a fee, wouldn't you do that, Ralph?
Definitely, because them fees add up. People underestimate how much those fees add up, bro. It's thousands of dollars over time. Thousands, bro.
Exactly. So before we dive in and show you guys, if we were building something really quickly, what it would look like, let's look at QQQ. So explain to the people what QQQ is, bro.
Yeah, so like we said, just like the SP 500, the top 500 stocks, QQQ is kind of taking the top 100, but it's really focused a lot on tech. All right, there's a lot of tech companies in the QQQ. So people kind of go to this fund when they have an interest in tech. That's why they've been so dominant in recent history, as tech has pretty much taken over in this new millennium.
Yeah, I love the way you said that, bro. It's taken over, right? So you want to invest in the top companies, and you want to invest in the best companies, and you want to invest in tech. Just do me a favor real quick. What are the top two holdings of now QQQ?
Apple and Microsoft. They come up with basically 25% of the fund, bro.
So 1/4 of the 100 company fund is Apple and Microsoft. So guys, we're not telling you guys right now that Rel and I are geniuses. By no means are we geniuses. No means are we the stock gurus of the world by telling you guys to invest in Microsoft and Apple. But at the end of the day, if you can look at this chart right now, okay, a 5-year period of investing in Microsoft, if you bought Microsoft at 112 on August, right, and you went all the way to current day, this is the return you would have. An annualized return, okay, of basically about 42% on average. If you think about it, this is a 209% in 5 years. So you're making 42% 22% on average per year from Microsoft. That's insane. You look at Apple, it started the same thing, right? About 56-ish, and then 191 right now. You would be at a 237% return overall. So that's what, like 47, 48% roughly per year, I would say. Bro, just think about that. Like, would you not take that every year versus what is the S&P 500 giving you, as we saw on average, bro? 13?
Yeah, just about.
So just think about this, guys. Like, why pay a FA to manage all your money if you have no idea what to do and you just made your own fund up, like a mini fund? Let's just call it the Bad Talk Fund, right? Like, you took the top companies from S&P and you're like, yo, I'm gonna rock with Apple, Microsoft, Amazon, Nvidia, Google. And you did the same thing with Q's, Apple, Microsoft, Apple, Tesla, all this. Bro, you're gonna make a great return without paying anyone a fee. And you guys don't want to believe me? Let's check this out really quick. So we found an article that's essentially talking about the top 50 funds collectively, right? Annualized gains were more than twice the industry average over the last 15 years. So 15.5%, okay, over the last 5 years. Bro, what did we just talk about with Microsoft and Apple?
Over the last 5 years, we talking about well over 200% each.
You know what I'm saying? Like, just think about that. And yes, there is going to be a drawdown. We don't want you guys to think there's not. Like, if you hold individual stocks, you're going to face a drawdown. But let's just talk about one quick advantage, bro, that individual investors, the people watching this video, have over hedge funds. Can you just explain that real quick?
So you're talking about as far as the fact that they don't have to pay a fee and the fact that they actually could double down when prices are low, right? Like, so
exactly. They don't have to rotate. They don't have to allocate. They don't have to worry about rotating sectors.
Yeah, because that's the thing. These hedge funds, they have to meet almost like a quota in a sense. They have to keep their investors happy. And so they're constantly rotating and stuff. And sometimes even a stock like Nvidia, they might not want to chase that as it's going on a run. We've seen this run that Nvidia is on, but they have investors kind of putting pressure on them like, yo, Nvidia is running and you don't want to get involved because they might think, yo, Nvidia is overvalued and stuff, but you're missing out on a lot of gains. And a person who's managing their own money, they could literally ride that wave. If Nvidia starts to come down, they could take their gains out and put it into the S&P 500. Like, you could literally just kind of rotate in and out of the best individual stocks and put your money from the gains of them right back into the S&P 500. Or you could just stick with the S&P 500 by yourself the whole time. If you're really like super lazy, just stick with the S&P, like you'll be fine.
I love that you said that, bro. That's actually a great segue into this point I wanted to make. So, bro, you pick one, right? You want to do S&P 500 to make it very simple for people, or you want to do QQQ?
Definitely.
You pick one.
Let's do S&P 500. It's the most classic one. Every hedge fund or anybody you're telling to invest your money in, they're gonna put in the S&P 500. No matter what.
Or they should, right? They
better.
Usually don't. They better, but most of the time they're gonna try to find companies, and I don't blame them, right? Like if I'm a financial advisor or I'm like an analyst at these funds, I'm like, yo, I get paid to think of the next biggest investment for these people, and I'm giving them S&P. Like it's gonna be a joke. So that's not what they do, which is like, I get it where they're coming from, but guys, as Rel said, the most simple one, right? Let's just say you guys invest, I'm going to just say $1,000 a month, okay? Because remember, you don't have to pay fees anymore. That's not a thing. You guys don't have to worry about that. On average, for 30 years, you just do this. Let's just say, because remember, since inception, we have right here. And what was the return I said? I think it was like what? Performance was what, 13%, I believe I said?
About 13.
13.76. Yeah. Let's just literally write that same thing, 13.76. And now give or take 2%. Guys, this is how much money you guys will end up making as it does a calculation. $4 million, bro. $4 million in 30 years. That's assuming that you actually make 13. If you get higher, it's 5. Let's just say you have a drawdown. It doesn't do that. It does 11%. You have 2.76 million. You see it on the screen right here.
So they go anywhere from 2.7 million to over $6 million, bro.
$6 million. And that's the crazy part, guys. Like, and we're not, once again, no shade whatsoever to FAs. I wanted to be one myself when I was younger. All I'm saying is if you cannot afford an FA, or if you think you need an FA to manage your money, or if you think you have no idea what to do, Rel just basically told y'all, like, QQQ or VOO is a very simple way out, guys. Like, personally, I will be very honest. My portfolio I'll be very honest. Apple, Microsoft, Tesla, Nvidia. I have some Square, I'll be honest. And then every month I invest in QQQ, VOO, and VTI. Like, I don't mix it up, bro. It's very simple because all you need to do is be simple.
Literally, bro. Nobody else needs anything besides this company. I mean, like, not to say, yo, this ain't advice, like, yo, get those companies. I'm just saying that that's the safest way to go about it, especially the ETF route, because if some people get nervous about the individual companies, like, oh, what if Apple goes down one day? Cool. VOO, we just told you, is the top 500 companies in the country. And the thing is, if Apple goes down, guess what the fund does? They replace Apple with something else. So no matter what, you know what I mean? They're gonna make sure that the fund stays afloat. It's investing in the top 500. So let's say the top 500 companies go down. You know, we got bigger fish to fry. Ain't nobody worried about your portfolio. That was America.
That point don't matter. That doesn't matter.
America is in flames. You know what I mean? And I kind of want to make a point on individual investing in general. People kind of look at Apple, Microsoft, and these big tech companies that's pretty much taking over the whole world right now, and saying like, yo, that has to fall, because we've seen big companies fall before. We've seen companies like GM Motors and JCPenney and AT&T. They used to be the Apples and the Microsofts of the world once upon a time. Now you got those same companies, they are nowhere near that. Look at JCPenney, how it all went wrong at JCPenney. You see on the screen, JCPenney right now is delisted.
Yeah, and that's the crazy part, guys. I wanna just really, what Rel is saying, I want to make sure this is very, very clear for you guys. It was trading around $104 a share in 2011. 140. That's not for a retail store. That's pretty damn great. It was considered to be the Amazon of spots beforehand. And then when you look at it, 2019, this article came out. Its space is delisting, and it did actually get delisted. Yeah. So that's just crazy to think about. And I want to let Rel finish the point, but just wanted to put this on screen so you guys see that what we had back then is not the same thing as today. So go ahead, bro. Finish your point.
That's the thing. A lot of people pretty much say like, yo, you can't just trust in one company, or trust in individual companies in general, because they go down. Like we've seen JCPenney go down. Yeah, the difference between Apple's and Microsoft's is like, JCPenney is not going across different industries and dominating the way that big tech has dominated. There's a reason these companies stay afloat. Like anything that comes about, these companies are getting involved in, and they have the capital to get involved in it and take it over. Like you see Apple getting involved with healthcare, and like, bro, these companies, no matter what, they're going across industries to keep their domination. These companies are getting involved in cars, healthcare, like, bro, it's all, they're in AI in every single way. If AI is the future, they're the spearhead of AI. If there's going to be any AI dominance, it's going to be amongst those companies that we just named.
And to make his point even more clear for you guys, I'm going to show you guys, right? Rel, as we said, QQ, tech, every time, just think about that, guys. This is going to make your point even more clear. So when we look at it, this right here is just essentially showing you guys the performance since it started, right? I believe QQQ started in 1999, right before the blow up happened for the tech bubble and .com and all that sort. So 9.17 since inception. Over the last 10 years, though, it's 18.96. That gap is doubled. Why? Because what he just said, like, tech is taking over. And if you think about it, every single top 5 company in this, I don't want to say like invest in this right away in this portfolio. You guys use Microsoft. If you don't want to use, a Microsoft product, you're going to use Apple. You have a MacBook. If you don't think you're using Amazon as like AWS, you're out of your mind. You order everything on Amazon. And that's the crazy part, guys. Amazon does not make its money from the delivery services. They actually lose on delivery services. Just to make that point very clear, that's called a business strategy, where they're making sure their marketing is so damn on point that you think about Amazon all the time, but they really make their money on AWS, which is their cloud services, Azure, which is Microsoft, Apple, all the stuff that you use on your iPhone, Nvidia, chips, Tesla, cars, Meta. Dude, I haven't even talked about it at this point. You guys are all over social media. Like Google, come on now. It's literally a dictionary term now. Like, just think about this. Pepsi, Broadcom, like, guys, these companies control everyday life for us. So at the end of the day, it's not like yo, you need an FA. I just want to make it very clear. No disrespect, but you guys could also do this yourselves.
Definitely could do it yourselves. I mean, look at some of these companies. You could talk about Nvidia. they've been up about 235% since January 3rd, from January 3rd to the peak that they've had. You see Tesla go up almost 100%. Meta's up well over 100% in the past 6 months, both of them. Like, the returns on these companies are insane. And it's not really rocket science to say to invest in these things. We're not some geniuses saying invest in Meta and Tesla and Microsoft. Like, bro, these companies are our everyday names. You can't go about your life without using one of these products. We're recording this episode right now with Mac computers from Apple. My AirPods in right now is from Apple. I'm saying bro,
do I have to go crazy? Like, I just Googled this return for you guys on NVIDIA. You just said 200 something percent, right? Over the last 5 years, if you just forget timing the market, just investing in this, overall 532. And analyze return, you know what I mean? Like, just guys, think about it, man. Like, at the end of the day, you guys have to put yourselves in the shoes of an FA. Their job is very hard. They have to make money from fees, so they're gonna try to make sure, you know, your money is doing a good job. I'm gonna just try to keep it at that. Just doing a good job, right? But once again, you don't need all that. We just told you our portfolio, essentially. It's very simple. So take advantage of that. That's all I gotta say on that.
Yeah, so enough said on that. I mean, what do y'all think? Like, what do you guys think about FAs? Do you think they're necessary now? Do you have one? What is your performance like so far with them? We want to know. We want to hear your thoughts. So that's all we had.
That's a fact. And hopefully you like this episode. If you're still watching, please make sure you like, comment your thoughts, and subscribe to the channel. Plus hit that little notification bell because we drop
2 videos a week.
You don't want to miss them. Check us out on Wednesday. But until then, peace.
Peace.
Soundstripe.